Hi guys, welcome to part one of my series on how to define weekly and daily bias. So I've decided to create a series on how you can simplify your way on how to define your weekly and daily bias, because I've seen most people are struggling with defining the daily bias and the weekly bias, right? And for those people that don't understand what the daily bias, weekly bias is, it's basically your higher time frame bias or your higher time frame narrative. In this case, you're trying to understand whether price is going up or down on a higher time frame, because once you do have that logic in place of whether price is going up or down on a higher time frame, then it's easy for you to actually just find the trades that align with that narrative and execute them in that bias, right? So this is part one of the videos. I'm gonna actually release a couple of other videos, right, on this, on the weekly and daily bias, using different concepts, right? So the first concept is internal to external or external to internal, right? So this is part one of the video. All right, so just before I jump into the video itself, I want to give credit to ICT and MMX Trader for these concepts, right? ICT is, first of all, the curator of all these concepts, and MMX Trader is one of the traders that has simplified some of these concepts for the public. So yeah, guys, let me jump straight into the video. Okay, so the first important component in building a narrative, right, is to understand how to structure your narrative and then confirming the narrative and then entering based off your narrative, right? And that itself has been broken down into different time frames that you can use, right? That are different time frames from the higher time frame to the lower time frame that you can use basically to come up with a narrative, then confirm the narrative, and then execute on the lower time frame, right? And therefore, these time frames are quite fixed, because initially I also had a problem with understanding which lower time frame or which intermediate time frame should I jump for confirmation. I usually use all the time frames and therefore get lost in the process. But in this video, I'm going to show you guys different time frame alignments that you're going to use, right? So there are basically four that I use, different four time frame alignments that I do use, but mostly I use the last three, right? So these time frames alignments are structured based off the long-term perspective, which is the first part, which is the first time frame that you're going to look for. And then you got the intermediate term perspective, right, which is lower than the long term, obviously, where you're going to look for a confirmation, right, of the long term perspective. And then you got the short term perspective. This is where you're going to place your trade, you're going to enter from, right? So with the position traders, people that try to hold trades for the longest period of time, maybe for like 2 weeks, 3 weeks, a month or so, they're most likely to look at the monthly, right, for their narrative, where on the monthly time frame, where prices whether going to the upside or downside, and then they're going to look at the daily, right, for confirmation of the narrative on the monthly, and then on the 1 hour, that's where they look for their entries, right? And then this goes also for the swing trader. Swing trader looks at the weekly for the narrative. This is a weekly time frame, by the way, and then the 4 hour for the confirmation, and then the 15 minutes for the entry. And then we do have the intraday trader. The intraday trader, which is my preference in terms of the time frame alignment. I look at the daily, then I jump on a 1 hour for confirmation, and I jump on a 5 minutes for entry. And then we got the scalpers, which look for the 4 hour narrative, 15 minutes confirmation, and the 1 minute entry. So it's quite important that you do have this in perspective, and the reason why is this small description that I just added here, saying to avoid analysis paralysis or gain clarity during analysis, use time frame alignment to build narrative, confirmation of narrative, and entry, synchronizing three time frames from high, intermediate, and low, right? So these time frame alignments are quite key in having a clear picture of what you are doing and what you're looking for. So once now that we do understand that we are building a narrative towards something, and the narrative is built off the monthly, weekly, daily, and the 4 hour, um, it's gonna be easy for us to jump into the rest of the concepts, right? So yeah, going forward, I'm gonna share with you guys how you're gonna build your weekly and your daily bias based off these higher time frame narratives, because that's where we look for the narrative. All right, guys. So just before I continue with the video, make sure that you do join the Discord group. The link is in the description. In the Discord group, I share my analysis, I share more information, I publish these free courses and free concepts about the strategy that I do use. So make sure that you do join the Discord group, and then keep track of my analysis. And then, yeah, hope you guys find it more informative. Actually, I do send a bit more descriptive things, right? So let's say you go to um, DXY, right? I track DXY on a weekly basis, so I'll be sending out analysis at the beginning of the week. I do send out analysis anticipating whatever that's going to happen during the week, and then I do recaps during the week where I do send out what's been forming and how price is structured, right? So an example is possibly this. Well, I was anticipating because I've been bearish on DXY, so this is something that I shared with the group, and everybody in the group had the opportunity to see my analysis and how DXY unfolded um, through my analysis. Okay, so see you guys in the Discord group. Okay, so when it comes to your long-term perspective, which is initial as LTP, the question that we ask ourselves is, where is price going? Right, where is price going? And then before we understand where price is going, we look at where price is coming from. Okay, price coming from this point, and then most likely it's going to head towards this point, right? Therefore, for us to come up with that understanding of where price is going, there are a couple of steps that you're going to have to look at, different steps that you're going to have to look at, and questions that you're going to have to ask yourself to come up with that answer, right? And then these questions, they are basically different components and different concepts that you're going to use, hence the name narrative, right? So it's a narrative. It's not a fixed thing and say, okay, based off this only, right? We're using different concepts to come up with the narrative or with the bias. So the first question that I do ask myself is, I make sure that we are trending, right? Is the market trending? Because we're trying to avoid range in markets. When I look at trending market, is the market trending up or down? And then if we're trending up or down, I want to make sure that I'm seeing down closed or up closed candles being respected, right? I'm going to show you guys what that simply means. Basically, if we're pushing to the upside, right, I want to see the bearish candles that are being formed while we're pushing to the upside being respected, because if they're being invalidated, meaning that price is most likely changing direction, right? And then if we're pushing to the downside, I want to see the down close candles. I mean, if we're pushing to the downside, I want to see up close candles, which are bullish candles in this case, being respected. So that's the first step. Are we trending? And then the second step is price premium or discount. And the reason why we need to ask ourselves whether price is a premium or discount is because of, we want to buy when price is discounted, and we want to sell when price is premium, right? So once we do have that question answered, we then move to the second step, which is internal to external or external to internal. Basically, what kind of liquidity are we looking to grab? Are we going for the internal range liquidity, or we're going for the external range liquidity? And then if we're going for the external range liquidity, we want to make sure that, did we respect some internal range liquidity, or did we grab or mitigate any internal range liquidity, right? And therefore, in this video specifically, I'm going to look at internal and external range liquidity, the relationship between the two liquidity, right? So once we do have that in place, we then go to the fourth step, which is higher time frame PDRA activated. So once the higher time frame PDRA activated, if we're moving from internal to external, we want to make sure that the internal has been activated and has been respected. Then we'll look for price to target the drawn liquidity, which is the external, the opposite of the internal. So if internal has been activated, we'll be looking at, okay, where's our external? That's our drawn liquidity, and vice versa. If it's external being activated, we'll be looking at our internal being our drawn liquidity. And then the fifth step is what's our next day model. Basically, as much as I define my narrative on a high time frame, being on a weekly, on a daily, on a week, on a monthly, I also want to understand the candle that's been printed, right? What's the next day model like? What is it most likely to move in my direction or not? Because it's possible that you might get the narrative, right? Say, okay, for this week, price is gonna push to the upside, and then you do have days where price doesn't push to the upside, but it doesn't mean that you are wrong. You just picked the wrong day in which price pushed against. I mean, which price pushed towards your narrative, right? So I always try to understand what my next day model is, right? And I'm going to share with you guys different concepts that you're going to use to define that. And then the last part is having some SMT in your analysis, right, to use, because we usually trade reversal patterns. So you want to make sure that you do have SMT forming, because SMT is more or less like a confirmation of price moving in your direction or not, right? Whether the reversal is true or not. So you look for SMT to support reversals at points of interest. Okay, so basically, when I talk about IRL and ERL, it's basically internal range liquidity and external range liquidity, and this is where everything starts from, right? So these are the two components of the market, of the charts, that you need to understand to help you come up with the narrative. When you're speaking about internal range liquidity, we're looking at fair value gaps, right? So there are different types of fair value gaps. I'm going to do a video on that too. And then we also have external range liquidity, which is the odd highs that price prints, right, when it reverses. So in this case, whenever we're trying to build narrative, we need to understand the relation between the two, because price simply moves from the internal range liquidity to external range liquidity, or external range liquidity to internal range liquidity, right? So on our left side here, we do have price pushing to the upside, right? And as price is pushing to the upside, we do see price right here taking out the external range liquidity. So once price takes out the external range liquidity, which is an odd high that was printed previously, we see price take out this external high range liquidity. What do we anticipate? We anticipate price to actually come back for any internal range that was formed within this range, right? So this is basically the fair value gaps that were formed in here. We'll be looking for price to target those on internal liquidity. So once price takes out the external range, the next thing that you want to look for is price to reverse towards that, right? And then right here, once price does activate the internal range liquidity, respects the internal range liquidity, mitigates it, right, which is the fair value gaps, we'll be then looking for price to move to the external range liquidity, right, to take out this external range liquidity. And then for the bearish market, it's the same thing, basically looking for price taking out this external. From external, we'll then be looking for price to come back into the internal, right? And then from here, we look up the price tags internal, we'll be looking for price to go for the external range liquidity, right? And then one thing that I want you guys to notice is basically the setups that are formed when price is moving from external to internal and from internal to external. So whenever we're moving from external to internal, it's a reversal pattern, right? Price is pushing to the upside, takes out the external range, then it reverses. And then whenever moving from internal to external, we see price actually continuing, which is price continues from this fair value gap to this external range liquidity. So this is basically the continuation pattern that we're looking for and the reversal pattern we're looking for. So it's quite important that you understand the relation between external to internal, because it helps you to understand what is being targeted and what is being mitigated, right? So with that understanding, it's going to be easy for you guys to actually define your narrative. So let me just jump into a couple of examples on how I built different weekly bias, daily bias, and narratives using this external and internal range relation. Alright guys, so let's jump into some examples of internal range liquidity to external range liquidity relation, right? Okay, so with this example, as you can see clearly, we've expanded to the downside, right? Prices formed the range. So let me just bring up a tool to draw the highs and the lows. Okay, so here we do have price actually from a high and a low, right? Expanding to the downside. And then within this range, we're gonna look for fair value gaps, right? So we do have a couple of fair value gaps right here. We do have one. I didn't mark that one up. And then we do have this one, right? So as you can see, these are the fair value gaps that we'll be looking for price to actually respect and then trade afterwards. So the idea is basically you wait for price to reach, right, the internal range. So in this case, we're looking for internal range liquidity fair value gaps. So look for fair value gaps, right? In this case, be waiting for price to actually respect those fair value gaps and then trade the days after price respects the fair value gap. So we don't try to anticipate price to reversal once it just gets to this fair value gap. We'll be actually waiting for it to respect it, then trade afterwards. So once it respects it, we see price rejecting. For instance, this first fair value gap was invalidated, right? So we wait for the second one. For the second one, we do see price actually starting to respect this, and then price actually grabs liquidity there, displaces to the downside. Then you see, okay, we're possibly getting to see some sellers coming to the market, and then from there we see price drops to the downside, right? As price drops to the downside, it grabs liquidity right here, forming another dealer's range, and then we see price forming another low right here. And then within this range itself, we do have another fair value gap, right? Price comes back into the fair value gap, right? We see price rejecting, rejecting, and then price then trades in the direction, right? So as you can see, obviously there are some days in this case, even if our narrative from right here, right, even if our narrative from right here might be bearish, it's safe to say that there's some days where price we actually see price is bullish, right? So in this case, these are the candles. So you don't want to trade, you want to avoid trading on these days, right? A day like this, a day like this. And then once, for instance, here price was respected, we do have a little bit of days pushing to the downside. So how best can you avoid trading on these days? How best can you just catch these days, the bearish ones? Right. So in the next video, I'm going to cover that, and the next day model, where I'm going to teach you guys how to refine the narrative into understanding which specific day you're supposed to trade that is in line with your higher time frame narrative. Okay, so let's move to the next example. Okay, so just okay, so here we do have another example, right, where we see price expands to the upside, right? So price expands to the upside all the way from here actually, right? Price expands to the upside, right? As you can see, price has been trending to the upside. It expands to the upside, right? And then what do we see here? Here we do see price after expanding the downside, it actually pulls back a little bit into this fair value gap right here, internal. So here we'll be building a narrative from internal to external, but the main example here was actually price moving from external to internal. But yeah, we did have an internal to external move where price moved from here to continue to take out this external move, external liquidity, right? So once we see price actually pulls the upside, takes out that external range liquidity, it then respects the external range liquidity. As you can see, doesn't close above the external range liquidity. And then once we see that price doesn't close above external range liquidity, we do see this down candles until price targets this fair value upside here. And then we see price just drops all over the downside. So having this narrative, understanding that, okay, we just grab external range liquidity, where is our next draw on liquidity, which is going to be the internal range liquidity. And then as you can see, this is a proper reversal pattern, right? So it's always good to understand where the next draw liquidity is, which is basically the internal. If you're moving from external, if you're moving from internal, it is the external. Okay, so our next example is this bullish setup right here, where we see price has been trending all the way to the upside, taking out external and respecting internal. This is quite a good example and quite clear, covers most of the things that I've actually told you guys. Okay, so here we do see price expand to the upside, right? And then as price expands to the upside, forms a range. We mark out our premium to discount, right? So expecting price to come into the discount. Once price comes into the discount, then we wait for price to actually activate the internal range by respecting the internal range liquidity. Then from there, we'll be looking at our draw on liquidity, the external range right here. We see price push over to the upside. After external range liquidity, our next row is internal, right? So once price says push it outside, we know that our next row is internal. Price then comes back into this internal range liquidity and then does the same thing here where it takes out the external range liquidity, leaving out the internal range liquidity that it eventually comes in, respects it, and then it keeps on doing that. As you can see, we did have a bullish order flow here and price was actually respecting the market structure. Yeah, guys, so this is basically the relation of internal to external. As you can see, whenever we're moving from internal to external, it's a continuation. Whenever we're moving from external to internal, it's a reversal. So understanding this concept makes it easy for one to actually derive a narrative of the market from the higher time frame. Alright guys, so that's about it in terms of building your narrative using internal range liquidity and external range liquidity. So you're basically looking for fair value gaps that are premium or discounted depending on whether you're buying or selling. And then you're also looking for external range liquidity in relation to those fair value gaps. So if you're looking at premium fair value gaps, right? If you are selling premium fair value gaps, you're basically looking for price to target discounted external range liquidity, which is an odd low. And then if you're looking at discounted fair value gaps, right, which is internal range liquidity, you'll be looking for price to target external range that's premium, right, which is odd highs, right? And then I'm sure everybody understand what odd highs and odd lows are. Basically, these are three candle patterns, swing high patterns, right, that you're gonna find on the chart. So let me just show you guys a couple of examples from here. Okay, so when I say three bar patterns, basically what I'm saying is price forming the swing. Okay, let me just highlight this. Okay, so as you can see, price forms this three pattern candle, right, where we see price form a low, right, and then it forms a lower low, right, and then price forms a higher low, right. So these three bar pattern basically is a swing low, which is classified as an odd low, right. And then here we do have this, right, your price forms a high and then it forms a higher high and then price forms a lower high, right. So this is a swing high, basically it's an odd high, right. So basically these are the external range liquidity that you want to look for, right. So these are the odd highs, right. These are the odd highs. This right here is an odd high, I mean an odd low, right. This is an odd low, odd low, odd high, and then this right here is an odd high, right. So there are a couple of them that you can see, right, and we're looking for these swing highs and swing lows that are formed uh, as in the external range, and then we'll be looking for price to target those basically swing highs and swing lows. Alright guys, so that's about it for this video. Make sure that you do write down all the steps that I've listed for you guys, and use the internal to external range liquidity relation, right? And then from here, I'm gonna share with you guys in the next video. I'm gonna share with you guys how to use the next day model, basically trying to understand which one is the best day in the week, right, to trade in line with the buyers, right? Because coming up with the narrative is just the first step, right? You can also understand when is the right time to trade in line with the buyers during the week, right? In the next video, and I'm gonna share with you guys on how to do that.